All right. Welcome, everyone. Excellent, excellent. Welcome, everyone, to Kettle Space's Founding Hour Raising Capital. I'm Joseph Katz. I work for Kettle Space. I'm here with Mac, my colleague. We'll be in the back end of this event. But before we get started, a few housekeeping notes. We are recording again. This is the first in a series of Founders Hours. There'll be one a month for the next few months. Again, please stay on mute and add any questions to the chat. So with that, let me give you a quick overview of today's event and Kettle Space, and then I'll hand the mic over to Alex, who will be our moderator today. So today, our panel of experts will explore the pros and cons of venture capital. They'll share stories and best practices for fundraising and discuss the current capital environment for those companies who are looking to raise money in 2021. A bit about Kettle Space. We were founded in 2016. We're a real estate technology company based in New York City with a network of inspiring workspaces and a passion for community development. Since the pandemic, we've partnered with organizations to help engineer solutions that address their immediate COVID challenges and to help them bring people back to the office with a variety of flexible workspace options. Our goal has always been to support, empower, and connect our community. And that's why we're committed to producing these great events. And we're super excited to kick this series off with an amazing group of panelists, which Alex will introduce. You're in for a wild ride. Hope you enjoy and have a great one. Thanks, Alex. Take it away.
Thanks, Joseph. And thanks, Mac, for having me. Thanks, Kettle Space. Super excited to moderate this panel. I'm really excited about the panelists that we have here as well. You know, as you'll see, they bring very diverse background and experiences. I think will add a lot to the conversation, starting with Vincent. He's the CEO and founder of Verb, a coaching and accountability platform who has helped raise over 10 million for startups over his career. As a serial entrepreneur, he has built successful brands that span from 2-people teams to over 200 employee organizations. He's led investment in and operated 2 hospitality brands in NYC with over 20 million in revenue. Geri is a partner at Laconia, where she leads seed investments in B2B software companies. Prior to joining Laconia, Geri was a business associate at Techstars Internet-of-Things program, where she worked directly with 10 portfolio companies on growth and fundraising. Geri began her venture capital career in Central and Eastern Europe at Launchub Ventures in Sofia and Credo Ventures in Prague. Harlan is a repeat VC-backed startup founder and managing partner at Foundational, where he works with early-stage startups to plan and implement efficient early-stage fundraising strategies. His prior venture, Reonomy, a commercial real estate data analytics platform, has gone on to raise over $125 million. Harlan has also been a founding member of companies in the blockchain, IoT, and on-demand labor verticals. You know, we have an investor, we have a founder, and we have someone who's done both and now helps people fundraise. So super excited to hear everyone's perspective. So to begin, the first topic we'll talk about is pros and cons of raising venture capital. I think everyone aspires to raise venture capital at times, but that isn't always the right option. I think the best place to start here would be with Geri. So would love to get your thoughts on you know, the pros and cons to a founder of raising venture capital.
Yeah, first of all, thanks for having me. And I'm a little surprised that I'm the first to answer this question. I feel like you should ask the founders in the room, as they have seen this up close and personal. But look, I think the pros are a little bit more obvious in the sense that if you have figured out something repeatable in your model, you're able to grow faster, you're able to capture more market share. There's obviously the signaling effect that can impact the kinds of talent you're able to attract to your company, as this can often be a factor when people are deciding where to take a job based on stability, upside, validation, etc. The cons are frankly very specific, case by case, depending on a founder's situation and the company itself. You know, the biggest one I would highlight is that you lose optionality the more venture capital you raise. So typically when you start a company, most people are presumably doing this with the understanding that they want the autonomy and the freedom to build whatever they want to build in the way that they want to do it. And they have a lot of flexibility in how they handle that journey and what path they go on. Once you take on venture capital, in particular from institutional funds, but really from any outside investors, it is no longer entirely your company. You now have shareholders. You are a fiduciary who's responsible to all shareholders. And the more capital you raise over time, the higher the bar is for what the ultimate outcome is going to be, so that it satisfies the expectations of everyone who you've promised a certain outcome to by taking on their capital. So that's the big thing I would really emphasize. Is you lose the optionality of having full control, and you lose the optionality of being able to run your company as a lifestyle business, grow it at a slower pace, because there's just an inherent agreement that you're making when you take on investment from institutional venture funds. So I'll pause there and let the founders on the call weigh in.
Yeah, sounds very stressful, taking on capital at times for sure. But yeah, Harlan and Vincent, would be great to get your perspectives as well.
Sure, I think Geri definitely covered the major items, but more specifically, one instance of the loss of optionality I've seen by some teams, especially through the impact of COVID-19 when things first started getting shut down. When you have $2, $3, $4 million of capital behind you and you've lost control of your board, and it's really hard to do it. And also, just I think sometimes, as you mentioned, there might like there's other forms of financing one can get, other types of investors one can bring on other than venture capitalists. One consequence is that people may not be thinking about is the cost of the capital is very high. You're giving up future upside in your company. And I think founders can sometimes be very, very prone to give away as much equity as they possibly can to avoid spending money. And again, as Geri put out, like generally you have a repeatable process when you raise venture capital. If your cash conversion cycle is very short, you might want to look at other kinds of funding that aren't as expensive to your future profitability.
Yeah, one thing that I would add, and both of their points were pretty accurate. As someone who's run both, self-funded or needed to be breaking even and cash flow positive from day one, all the way up to taking investors from day one, is the difference in it being clearly a lifestyle business, or I wake up every day and I have to meet a bar, I have to meet expectations, I have to answer to people. And the idea to take outside money just because it sounds really cool over the past 7+ years, it changes what you have to do every day. And the buck doesn't really stop with you. You have to answer to other people who, you're responsible for that money and you're responsible for the success of that company. So they're two very different paths. And I would say taking on venture capital or taking outside investment makes the stakes significantly higher and adds a level of stress into running, perceivably your own company when in fact it's not really your own company.
Oh, thanks. I know we spoke a little bit about some of the stories of raising capital and sort of like some of the misconceptions that people have about raising capital. Harlan, I know you shared some stories, but wanted to give you the floor on that.
Yeah, the first thing that came to mind, since we're on kind of the more intricate aspects of venture capital other than the money changing hands, I think one misconception is that investors really do care about how much of the company the founders own. We've seen a lot, especially the situation where a new CEO was hired into a company and then successfully scaled, and the company's now going to raise venture capital. Oftentimes, the executives don't own the right amount of the company, and the investors are very conscious of that in the early stages. I've seen some deals fall through, and that can lead to some really uncomfortable restructuring conversations. So generally speaking, I'm sure everyone here has a different opinion on what that threshold is. But if the CEO doesn't own like at least like 20-25% of the company after a seed round closes, it looks really strange to outsiders. And similarly, just on a related note, the ownership expectation of the investor, they don't want to own your whole company. They want to make equal weight investments typically throughout their portfolio. They want to hold generally 10 to 15% of a company when they write a first check, and that kind of scales up through even growth stage funds. So that's one of the reasons they want to see. There's a lot of reasons why investors want other investors to join a round of funding, but one of them is they actually don't want to own more than they're supposed to.
Cool. And then Harlan, you also shared like just a couple stories about your experience fundraising and the first time fundraising and second time fundraising. But I think it would be helpful to hear what those experiences were like.
Yeah, it's always fun to learn from other people's mistakes. So I'll talk about one. I was the technical co-founder of Reonomy. It's a company that's done very well, which I'm very thankful for. And then the second time around, I co-founded something, and I thought, for sure, based off of reputation and macroeconomic conditions, type, and like some early MVP data will be enough to raise a seed round. And nobody cared. It was just a horrible business idea. Not that it couldn't have been venture scale, right? I do think it was a venture scale opportunity, but it was just the wrong kind of customer segment, and the character, it was like a one-time recurring use case. It was a very expensive customer to acquire, and it'd be hard to get them to come back and buy more things. And everybody saw it, but me and my co-founder. So it was a very good learning experience, even after a big win.
Yeah, I think people, tend to believe that just because someone, successfully ran a company before, that they'll just be able to easily go out and raise whatever they want. But, that isn't typically how things work. Geri, I know that you were mentioning on our call also just some, misconceptions as it relates to what founders are focusing on during meetings, such as KPIs and things of that nature.
Yeah, it's been interesting to see startup pitches kind of evolve over the last couple of years as there's been more and more content put out there on what to put in your pitch deck and how to structure your narrative and all of this information that, frankly, I think in some ways it has led founders to focus on telling their stories in a way that checks boxes and is like, well, we did the thing that the slide deck template said we should have done, and it said we should have some traction. So here are 3 point in time traction metrics. So why am I not able to raise money now? And I think a little bit of that over-indexing on these frameworks and structures has taken the focus off the storytelling around momentum and upside potential. So I guess this is less of a misconception than it is sort of a frequent, I don't even really want to call it a mistake, just a frequent misframing of an opportunity where founders are often indexing on, we've achieved this many customers and we've achieved this much in MRR. And they're like, now that I've captured it, bird in hand, this is validation. Where I think realistically, the more valuable thing to show is what foundation you've set now that gives you visibility into the next 6 to 12 months of the business. So from my perspective, I'm much more interested in pipeline built and assumptions validated around how that pipeline will convert than I am interested in what exactly the MRR number was last month, right? Whether it's 15K or 32K or 60K, less important than what you've been able to kind of validate and what that tells you about what you're expecting in the future. So I guess if there's kind of a key takeaway there, it would be to always think about any of your traction and validation metrics as things that validate the assumptions of the momentum-based story that you're telling, and positioning that growth in that way.
Yeah, I think that's a great point. At the end of the day, investors are investing in the long term in a story, in the long run. So it's important to not get too in the weeds of what's currently happening and to be able to sell that bigger story. Vincent, I'm sure that you probably have some stories or things that you've learned through your pitches that are relevant to the conversation.
Yeah, Geri said something really interesting that guys, I think, may have even flown past your heads a little bit. Like as a founder who pitches, all I get all day is someone else's opinion on what I should be doing and what I should be saying, and the way to, like you said, Geri, like check that box and this and that. And even for me in my pitch deck in my company that I'm raising for right now, our MRR is a footnote in my email to my deck. Like, hey, just a quick update. Like, this is where we're at. It's not even in our deck. And the biggest thing I always try to remember is, and I'm going to just use Geri as an example, and I hope you don't mind, like she's still just a human. She's buying my energy. She's buying my story. She's buying my dream. Yeah, there has to be assumptions that we've laid out and we've thought about and we've critically given parameters around that are either going to work, or if they're not, we'll chop it quick and move on to something else fast enough to that we can continue to move in that direction. I think a lot of times as a founder, we get caught up in that last pitch that really kicked you down, or the friend who you thought was a shoe-in to open doors and was like, oh, like you're not doing enough MRR. And I'm like, well, you know, what do you mean? Is that really that important when my expectation is 1,000 times this? So really, guys, get, you know, being clear on the vision or the dream or whatever gave you that first spark, stay there and just be detailed oriented in what's working today to get you to where you want to be. And I found that the right investor is going to pick that up as soon as you're putting it down.
Yeah, absolutely. I think that people lose sight of the fact that investors are human and we, you know, make mistakes all the time and, you know, believe or don't believe in things for all the right or all the wrong reasons. So it's definitely, you know, don't let the meetings affect you too much. On that note, Vincent, I also wanted to discuss with you. You were speaking about in our conversations about you know, things like transparency, you know, things that you've learned from your pitches, some best practices. So I wanted to discuss that with you. From your perspective, what are some best practices for founders out there in their pitches?
Yeah. So as far as transparency goes as a founder, right, guys, there's no good time for bad news. We like want to share good news so fast, right? It's like, I can't wait to tell you about this and this client and that article, but equally, especially to your investors who bet on you and bet on your dream, there's no good time for bad news. So the transparency around what you're struggling with is super important, right? Your investors are there to support you, to be with you. No one expects it to be roses forever. So when it comes to transparency, it will build years of value with whoever you're being honest with. And I've been fortunate over the past 12 to 15 years that, you know, I've had some ups and downs in my career, and the ability to have hard conversations pays dividends more than any random one-time check. As far as pitching goes, transparency is a funny one in pitching, right? Because you want to like be honest and be you and be authentic. And sometimes that one authentic thing, like, hey, we had 2 huge months of growth, but then like, we don't know why this customer acquisition channel just failed for us this month. Like, there's like this fine line of really getting the interest from, you know, a VC or a big potential investor. So you never want to be lying or fabricating, but you have to be able to paint a picture that might not currently exist. And that is a super, super delicate line that I've always had to dance, where you're like, this is what we're doing and it's working. And these are the things that are great. And a dear friend of mine, and obviously a lot of you guys know him, Nick says something funny. Nick is, guys, on the call, and he's the founder of Kettle. We've been friends for a long time, and he always talks about, you know, you want to be able to identify the things that aren't working, but same time be like, this thing's way shinier than this blemish over here, right? So there's a way to be transparent about what's working and not, that builds respect. That I think checks come from respect and honesty more than anything else.
Totally. Harlan, Geri, I'm sure that you guys both have ideas for best practices or things that work well in pitches as well.
Well, I think following what Vincent had shared, I would continue by saying every business model, like nobody like invents their business model really. Like there's only, I don't know, 10 different ways to make money or something like that if you count them all. And, you know, there's different go-to-market strategies. Each one has like a well-known risk to it, right? And I think everybody kind of knows, whether they're consciously thinking about what those well-known risks are or not, like defensibility or whatever else. It's important to be upfront and center about how you've addressed those common risks. Like if that part of your business that's not shiny is that one thing everybody's concerned about, like, you know, the supply side of a marketplace can't get enough people to do it or pay them the right way or whatever. like that's going to be trouble. But, you know, certainly, you know, like one example we saw recently, it was a Series A stage company and a really well-known VC. I think they're just looking for an excuse to back out of the deal, honestly. They're like, that customer acquisition model is just like not scalable enough. You're going to be competing for clicks and all that. Man, if only you had tested mailers, we really think mailers would work well here. Like nobody's going to mess up mailers. Like, sure, that's a great strategy at scale for the kind of business this was. I want to like kind of protect the company a little bit, but you know, like that's not rocket science. Like everybody knows, like for 50 cents per thing, you just hire like, you know, pretty good marketer and they're going to nail that strategy. So that's what I would add.
Yeah, I agree with that. I think two quick things come to mind to add to that. One is, I think having that self-awareness in meetings while you're still in the fundraising process is really valuable, so that you're not coming off as, I mean, in a sense, clueless about certain risks or gaps in the viability of the business or the trajectory. So I think that transparency makes a ton of sense. There's also, on the flip side of that, though, an opportunity, and frankly, I think it's every founder's right to kind of push back when your investors are going down the wrong rabbit hole in these meetings, where they're over focusing on an issue that's not really a true issue, or is just not the point. So I do think, you know, founders should always just feel comfortable and open to just saying, yep, we're aware of this, here's how we're thinking about it, the risks are mitigating. But really the more important thing is this particular element, or this is actually the bigger opportunity here, or this is what we're more focused on getting right. If we get this right, that piece won't be as important or as critical to our business. So definitely feel free to take control of that narrative in these meetings, especially if people are kind of going off course. The other things that comes to mind is we have an onboarding process after we invest in a company, where we set up a meeting with the founders and we ask them a couple of questions. The first is, what has changed between our diligence process and now? Because often there's, you know, multiple weeks, if not multiple months of closing, documentation, et cetera, and you're not really like double checking on everything on an ongoing basis in the same way that you were really digging in during the diligence process. So what's different now? The other question is, what didn't we ask in our diligence process that we should have asked? And what did we ask and you answered mostly, but not 100% honestly? Because at this point, the money's wired, the check is in the bank, we're married, and whatever it is, like we're all on the same side now, and we're going to have to figure this out together. So we, you know, I guess I would think about this with any investor who you're pitching. Sooner or later, they are going to find out. You should want them to find out so that they can help you and really navigate the rest of your fundraising process with that expectation. If there are things that you would not want this investor to know post-investment, you probably should not take their money. If you really think that this is not going to be a partnership where you can come to them with the problems and challenges and be able to work through them together, they're probably not the right fit for you.
Those were some.
Can I jump in really quick? Geri made an awesome point when it comes to what side of the room Geri sits on and what side, let's say, I sit on, and we'll use us as a perfect example, right? Geri's job is to place money with passionate, smart founders who have a vision that scale all the stuff, right, that we know about VC. My job is to know text message, accountability, artificial intelligence paired with a human. So while she may have questions about that and like general perceivability about what is working or not, guys, at the end of the day, you're the experts in your business. Don't be over egotistical about it, but be clear that like you're running a business, you live and breathe and spend thousands upon thousands of hours in this one discipline. And Geri's job is to be good enough to know that you're the one to take that the right direction. So awesome point, Geri.
Yeah, for sure. I'm definitely going to apply those questions to our onboarding meetings, but I definitely can't tell you like, you know, we'll be looking at the company and they'll be like, yeah, like we're closing at the, like by Friday and we'll invest that week. And then we'll have like a meeting the next week and I'll be like, oh, well, you know, we actually pushed it back like a week or two or something. Still trying to close these funds that were, you know, we're already supposed to have closed. But yeah, those are phenomenal questions. On that note, I wanted to cover the topic of when an idea becomes investable, like from like an institutional investor standpoint. I know that we spoke about this a little bit, Harlan, so I wanted to give you the floor, but when should people start thinking about raising venture capital funding?
Oh man, I'd love to hear other people's thoughts on this too. In my view, it has to do with like the intersection of what you're innovating on and how crowded the space is. So for example, if you're unlocking a new capability, and this is one we're looking at now or working with now, someone needs really clear guidance on an FDA clearance, and all the investors, like generally investors love everything about this company except the fact that it's not super clear if the FDA will approve it or not. And they've had enough conversations where it's clear that's it. They've found a way to reduce the amount of spend required to get to that point, but also at the same time, with that change in strategy, not materially changing the go-to-market strategy of the whole business. They just like shifted priorities around. So like for that kind of business, that seems to be what's going to work. Of course, no guarantee, but like they have a clear path forward. If that's not it, they have a clear path forward from there, right? Whereas for a company in a more crowded space, like maybe what they're doing that's different is a better packaging of the market segment and the technology they want to use. They're not like creating the technology. It's probable that they're going to have to prove that there's enough potential customers out there that are not being well served, and that requires a lot of things Geri was alluding to earlier with repeatable sales cycle, kind of reliable unit economics, and things like that. And it's not necessarily the case that you need to get to like 100K a month MRR. A lot of people who are probably thinking when others mention these like benchmarks, like they're probably thinking of, well, I just got like 6 rejections from investors saying they're looking for $1 million run rate. I think again, investors are humans and they have heuristics they use to make decisions faster. But if you can emphasize the right quality metrics and the fact that your growth rate is repeatable, if you're growing 20% a month for like the last 8 months and you're almost at whatever that barrier is that people are talking about, people will want to start looking at it. And also don't forget, the right way to approach an investor may not be to say, hey, I'm raising $3 million right now. It might be to say, I'd love to get to know you and your fund better because we're growing really quickly and we're going to be raising at some point. And that just sets a different expectation for the conversation. If someone says, I don't want to talk to you because you're not at $1 million in revenue yet, they didn't read your message or they didn't understand what you were asking them for.
Yeah, I think those are really good points, especially when you approach it as not looking to raise money that second, but as to like learn about when that fund likes to invest and sort of start building that relationship early can make the conversation easier later. But yeah, I would love to hear from both Geri and Vincent on in your view when you see an idea as being investable.
Geri, you want to take the floor or you want me to go first?
Go for it.
All right. So I don't think there's any good time to get in front of a VC, as Harlan just said, right? It's like, if you happen to know someone who knows someone who could say, hey, Vin, Alex is a good guy, go have a conversation with him. And he only invests in B2B SaaS products, which might not be mine, right? There's no wrong time for me to have a conversation with him. And I've done it incorrectly in previous companies too, where you don't want to be in front of the person you might want to ask for money from too soon, in the downside risk that they're going to be out before they're ever in. And again, it goes back to the right investor is going to be the person writing the check. So if I were to get in front of Geri, let's say a year and a half ago, when I was still doing friends and family money, obviously I might not be in her sweet spot or even on her radar, but at least her knowing me for, let's say, the past year and a half, I could then say, hey, Geri, just want to get a look at my deck. I think we're in that sweet spot for a big seed round. What do you think? All of a sudden, Geri knows me well enough. She knows that my product is moving in a good direction. I've had some hiccups. I've learned from them. And now she can confidently point me in a good direction or say, even though you're a consumer product, you might actually have something that interests us. So to answer the question, I don't actually think there's too early of a time to be on an investor's radar. Building the relationship will far supersede waiting to check those boxes of MRR or whatever, because like you guys said, I get the sense always that they're looking for a reason to say no, right? They have to check those boxes on their own to make the quickest diligent decision possible. And in doing that, they give themselves, and VCs give themselves, those checkboxes. So I would say when you have some kind of meaningful movement, whether it's traction or revenue or news pieces, or, you know, you had a really good patent come through, something that starts to separate you outside of ideation and exploration, unless that VC fund is clear that they want to be there when you're just thinking about the idea.
Well said.
Yeah, it's interesting. It really depends, first of all, which market you're in, and frankly, who you are and what your background is. So my perspective is heavily skewed toward East Coast US ecosystems. So this might be different if you're in Silicon Valley, San Francisco, where there seems to be more pre-seed capital at an institutional level. My perspective from the East Coast is there is just a massive gap in that capital stack before seed rounds of 1.5 to 3 million. But that's really the first point at which you're going to actually have a critical mass of funds that you can run a process with and talk to. Everything before that is a slog of putting together accelerators, angel rounds, a handful of pre-seed funds. I mean, literally 5 to 10 funds that I can think of that are writing sub-$1 million or sub 500K checks into sub-$1 million rounds. So from an actual fundraising perspective, approaching institutional VCs, again, East Coast based, for this kind of seed round, I think that's the point at which it actually makes sense to really start focusing your efforts. Now, of course, raising a round of 1.5 million plus has implications around how far along you are and what you've validated so far, which I think Vincent and Harlan have done a great job covering so far. You know, the majority of these rounds that you read about, pre-seed round of $6 million before the product launched, there's a reason those are TechCrunch headlines because they're outliers. Like, that's not reality for the majority of founders for a number of reasons. But largely, I think founders should tune that out until they've gotten to a place where that's, you know, viable for them, right? If you're not coming out of that ecosystem in some sort of immediate manner where you are personally close to a lot of these people, it's very difficult to replicate that kind of raise. The relationship building piece that Vincent mentioned is super important. I think it's really meaningful if founders, I guess the one thing I would say is I would be careful to really start approaching investors before you have any sense of what the plan is, in a sense. Like, I think at that ideation phase, it can actually be a little bit dangerous to overshare. And then the VCs, like, because they're not in the weeds with you day in, day out, they're getting these updates once or twice a year or once a quarter. It can seem unfocused and flaky in a sense, right? Which is not fair at all, because the entire founder process and startup growth trajectory is this series of experiments. But without enough context, it can kind of make it seem like they've now heard about you one too many times and you still haven't figured anything out. So I think it's really valuable to build that relationship over time. But once you have a reasonable path to actually doing what you said you were going to do, if that makes sense. If you're like, hey, here's what we're testing, here's what we're going to iterate on, this is the plan. It's really nice if you can go back 6 to 9 months later and be like, hey, remember what we said we were going to do? We did it. And here's the results and here's what we learned, as opposed to it being two totally different things in terms of what you expected was going to happen and what you realistically ended up choosing as the path. So that would be my caveat there, that there is a thing as a little bit too early in that regard in the experimentation phase. But ultimately, I think it's spot on that you want to have those relationships in place so that you at least have a short list of who are the people who you would want to work with when you're ready to raise money, so that you're not starting that initial meet and greet process once you're now on a timeline where the clock is ticking and you need money in the bank in the next, 3 to 4 months. Ideally, you'll be able to kick off a more formal process, having already met a bunch of people in the ecosystem with a pretty good sense of who would be the right strategic partners for you at that stage.
All really amazing points. And definitely, like, there's a bias towards, reading those TechCrunch articles and, having your Crunchbase newsfeed every day and seeing these big rounds. And it really is it's a graveyard out there of companies. It really doesn't paint the picture of how difficult it is to raise funding from investors and what expectations can be. I discussed this topic with all of you, talking about the friends and family round. I think that, the seed round's gotten bigger, the A's gotten bigger, and now there's like, the angel, the friends and family, like the all these checks sort of happening before bridge round. And I think the friends and family round can be unfair. So there's two things I wanted to mention about it. Firstly, if that is a route that people decide to go, friends and family, how to raise it and what to keep in mind while raising it. And I know that Vincent, that you had a lot of really great thoughts there. And then secondly, telling someone to go out and raise friends and family, like 100,000 or 200,000 isn't the reality for a lot of people. You can't just go out and do that. So what are alternatives when that isn't an option to getting your business to a place where you can raise that seed round? So yeah, Vincent, maybe you want to start off talking about what to keep in mind when you are raising the friends and family round.
Yeah, so it's I've been super fortunate that I have some amazing immediate people in my circle that either believe in me or we've made money together in previous ventures. So I've been really lucky there. It didn't come without its awkward conversations and loss of friendships and things of that sort. It happens. That's a real thing. And I think over the course of my career, understanding what that check means to a person in the friends and family round is super important. While you might be raising 100 grand and you're like, oh, this is easy. I can get 5 grand from a couple friends, I'm there. Or I can get 4 $25,000 checks and I could ideate this process. That 5 grand might be summer camp for your friends' kids, or 25 grand might be that first year of college for somebody. And while the excitement of being an investor in a startup might overweigh the downside risk that I think a lot of friends and family don't truly understand, really digging into the weeds and qualifying, even though it's your friend or your uncle, knowing that like, hey, you're going to write me a $15,000 check to try to solve eco-friendly dog food. It might be gone in 3 weeks. And I don't mean gone like we're going to think it out. I mean gone, right? Like it's a loss on your tax return. It changes the conversation and it might mean someone's out, but it will definitely offset the heartache later in the event you don't succeed. And that's something that's taken me a long time to learn. Getting the right amount of money from friends and family for that specific person changes everything and makes your life easier as a founder.
Vincent, can I ask, how do you go about setting terms with friends and family investors at the earliest stage? Yeah,
this is an interesting one, and it's a very, and everyone's got like a little grin, and one of my early investors is on the phone too, so it's not a conversation that I've shied away from because let's say that Verb becomes a multi-billion-dollar company, right? And that person's $5,000 or $10,000 might become 250 or some life-changing amount of money. But a lot of times they can't rationalize the fact that like $2 or $3 billion worth of shareholder value was created and that their taste was say $250,000. And it's a really odd conversation because you're like, no, yeah, I get it. Like you were the first person to believe in me, but you did make 10,000x your money. It's odd. So to be honest, Geri, I did them as notes. We gave what I was perceived as a roughly fair convertible, whether it be a discount to a priced round or some pre-discussed conversion rate that I felt was fair enough. I gave away probably more than I should have to my early investors. But at each stage, I had a very candid conversation about what those expectations should be, right? Like someone writing a $5,000 or a $10,000 check to have $0 or $250,000 is a home run, right? Like, I mean, at least to me it is. And understanding that someone like yourself who might write a $1.5 or a $2 million check, that risk is significantly different depending on what side of the room you're looking at. But you might, taking 10 or 15% of the company, look for that to become $150 or $250 million. And then you have your own metrics within your fund. So again, guys, that transparency about like what that risk really means, like most friends and family are investing in you. They might understand the business, they might resonate with the business, but the reality is it's like, hey, I'm doing this, I'm setting down this path, and they're investing in you. And most of the time, and it's a great problem to have, like, hey, I thought my 10 grand was going to be 10 million, right? Like, as opposed to it being $1 million, right? But still, it's an awkward conversation. And I've been an angel very, very, very early on for 5, 10, 15K, where again, it becomes a $100-500 million exit. And you're like, damn, I kind of thought I would have made more money. And even the dilution economics that happen around raising large sums of money, it's something that a lot of people don't understand, and they don't understand what it takes to build that enterprise level business. Again, it goes back to transparency for me. And I hope I answered your question.
Cool. That's yeah, super interesting. So I want to make sure that we have time. I know I wanted to get into the alternatives of friends and family, but I want to make sure that we have time to talk about the current capital environment before moving on to Q&A. I feel like maybe Harlan, you have some thoughts on just the current environment. Obviously, an interesting time given the pandemic.
Yeah. I think, as far as venture capital is concerned, it seems to be a very, very healthy market. I wouldn't have said that necessarily a few months ago. Like, so 6 months ago, clearly a lot of startups were raising money, a lot of venture capital activity. Volume was down like 50% year over year. That were growing well actually seemed to have inflated valuations. There was maybe like a survivorship bias there. So the reason I wouldn't have said it was great a few months ago is because people that I knew that were trying to raise funds were having a hard time raising their own funds, meaning venture capitalists raising their own capital to then deploy in the startups. A lot of announcements of new funds raised the last couple of months. I guess a lot of them are being announced in the new year. And I haven't looked at it from a statistical standpoint, but it seems to be a very healthy market all around. I don't see any signs of distress.
Yeah, I'm not sure if Geri, if you wanted to throw in anything as well on the current capital environment, or the sort of deals that you're seeing. I know the valuations have been pretty out of hand on our end right now, but
venture capitalists never like the valuations.
I just feel like, again, there's such a disconnect between what you're hearing and reading in the news and what the day-to-day reality is at the earliest stages. I think on a macro level, there's obviously been a tremendous amount of liquidity over the past few months, both in terms of M&A exits, IPOs, SPACs, all of that, which I think is going to be really positive for the ecosystem because that flows back into LPs and new funds and new founders all over again. But realistically, if you're a pre-seed founder, just from conversations I'm having with people, like, it's not necessarily any easier than it was 6 to 9 months ago. And so I would really just mostly encourage people to focus on getting their business to whatever validation or milestones that they were thinking about. Venture is such an exception-driven business that it doesn't actually really matter what the averages or the medians are. Like, the only thing that matters is the position you're in and what you're able to really generate. And so I would just focus on that and really not give that much attention to the broader industry-wide trends. In a sense, it's unlikely to really matter to your particular business.
It's a great point, Steph. People, I think, can definitely get lost in the data and make assumptions about their own business from it. On that note, I want to make sure that we have time to answer any questions from the chat. Joseph, I think you've been monitoring the questions, so yeah.
So we have a question from Jason Velasco. You want to ask it yourself, Jason?
Sure. So hey everyone, really interesting conversation, and I've been down the entrepreneurial path, but this is the first time that I've started looking for outside money for kind of the early stage things. And my entrepreneur mentor, who's done this a few times, has directed me to leveraging the lean canvas approach. I don't know if you guys are familiar with that from that methodology in terms of trying to understand really more building customers versus focusing on building dollar amounts and focusing on testing and validating in smaller increments in terms of, and then building traction and then scaling. I guess my question was specifically around, you talked about MMR, which is that monthly recurring revenue. How do you reconcile that with in the early stages of when you're building a client base where you may not have that standard MMR, but at the same time, you want to be able to basically show that you may have accomplished your measurements early on in terms of I've gotten 2 clients, I'm doing a lot of white glove support behind it, even though it's not fully automated from those type of things. How do you reconcile that in your pitch decks? Go.
To be clear, are you talking about the pre-seed stage?
Yeah,
Those
exactly.
very early revenue customers?
Yeah.
Yeah, I'd be curious to hear what everyone else has to say too, but I would be focused on what you've learned and validated and what that tells you about this next sort of set of milestones that you're looking to achieve with this capital. So we have validated willingness to pay within this customer segment. We have validated that this customer segment seems to be a better fit than this one for these reasons. We have validated that this is the integration that's required into their workflow, and really focus on those key learnings and what they tell you about the next stage of growth. I think the actual numbers and KPIs and metrics are less important at that point. I don't think the analysis that's being done is not that 25K revenue number should have been 30K, or that paid pilot should have been a recurring revenue stream over X months. Those are mechanics that I think are less critical at that stage versus the actual learnings and assumptions validated over that period.
We encourage quality metrics, like it's kind of extending what Geri was saying. For example, engagement time in the application. It depends on the kind of application, the modality of how people engage with it. But for example, maybe the paid pilot hasn't converted yet, but you can demonstrate a clear business case. The customer had like 10x ROI, and you have a testimonial from like the COO or something like that, and it's it's a brand name people have heard of.
Jason, at that stage, right, where you're looking, and I think Geri hit it perfectly, like paying attention to some of those metrics might not really be what sparks that interest. What is a success at that stage of your business? Whatever you're finding is working, start highlighting those also, right? Because at the life cycle of that business and wherever you are, whether it be pre-product or iteration, or you're doing A/B testing, whatever's working and you're learning from and is highlighting success for you and your founders and your team, highlight those too, right? At that stage, at that pre-seed or seed stage, you want to say, hey, look, like these 2 pilots worked and they're converting into paid clients, or one worked and one didn't, and it didn't work for this reason. This is where we dropped the ball, and this is what we've changed. Right. So what you consider a success, I would highlight those also.
Okay, thank you. Yeah, I mean, I have a bazillion other questions, but I'm not going to let so go next one. Thank you so much. I appreciate the insight though.
You almost stumped them, Jason. Gail has a question, not explicitly related to fundraising, but definitely something for our first-time founders. So Gail, why don't you ask?
Yeah, I was wondering if Kettle had any like an incubator program for founders, especially founders, women founders, or people of color. Do you guys have any mentorship programs or incubator where we can actually really learn how this whole process and how it works?
Was that specific to Kettle Space, or are you looking more for advice from the panel on who they may recommend?
Yeah, and for Kettle Space, both.
So we don't currently, Kettle Space doesn't currently have a incubator, but I'm sure the panel has some ideas or suggestions on, the ideas you just described.
I'll chime in here. I wanted to work on Wall Street when I got out of college, but my dad owns a fence company, which means he knows 0 people on Wall Street. So I had no relationships, I had no mentors, I had nothing in that direction. And the reason I bring that up is what you just asked is I think, and I can make an assumption here that you might know someone perceivably more successful or further down the road than you might be. And that might be a great starting point for a mentor, or at least someone to bounce ideas off of and at least get some direction. And that's how I started, right? I was like, okay, John Smith or Jane Doe, they're a little bit further along the line than I am, and they may not be the perfect mentor. They may not have a huge checkbook or this huge network, but they could at least help me move from 1 to 2, and then I could figure out how to get from 2 to 3. And then from 3, I could figure out how to try to skip 4 and get to 5. And I know that doesn't answer specifically your question, but at least when I started doing the mentor search or how to expand my network, that was how I did it. Typically, anyone who's, at least in my case again, had some success and has really struggled to build a company or have some kind of growth success in a company, there is some pay it forward there. And at a minimum, you can get a cup of coffee and at least pick a brain. So I hope that helped a little bit.
Mhm. Thank you.
And Gail, we do have a community that you could tap for help. We can make sure you get access to that if you're not currently in there.
Oh, great. That'll be amazing. Thank you.
Gail, what are you hoping to get out of a program?
I think that, a lot of founders, especially, like I said, I'm a female founder, women of color, people of color, we're kind of like not have a lot of knowledge in that process of like, okay, I have this great idea, but there's a lot of great ideas. How do I know if this idea is even worth me going forward or even looking for an investor? So I think vetting that process, and number 2, the education that it takes to put a deck together, to put the numbers together. And then even, just understanding, what is needed in a presentation, how to present yourself to founders. I mean, I think that this is just a process that a lot of people that I know personally, and a lot of people that just been on webinars, they're all kind of having the same problem. It's like, we want to be inclusive. There's a lot of, big VCs, small VC companies out there, but I think just the education part of it is really what's needed. I mean, I hate to see that there are so many great people of color who have wonderful, innovative ideas don't get that opportunity because we just don't really know where to start or feel too intimidated to even start the process. Or like, I would be afraid to call if I didn't find this webinar, because I'm looking, so I'm searching for great things. And I looked up the company. I'm like, they're in my neighborhood. They're in New York. I mean, that's great. I feel, I could get on this webinar and really learn a lot. But there's some people who just won't even get to that process because it's a very intimidating thing.
Yeah, no, that makes a lot of sense. I think most of the accelerators and structured programs out there are focused, somewhat ironically, a little bit later stage than the stage that you're describing. Mm-hmm. I think what you, as I'm understanding it, what you're explaining is really kind of at that ideation phase and even validating whether this is viable for sort of a venture track or an investor base at all. And I think Vincent's point on really having conversations kind of one-on-one with people in the space is a more helpful way, in addition to just kind of pouring through some of the public resources that are out there that are put out by all sorts of accelerators and venture firms on some of those fundamentals. But I guess in a nutshell, I don't think there are any programs that I've seen that are really specifically geared to that ideation phase that you're talking about.
Yeah, well, I want to just quickly mention that there's a lot of good ideas in the chat too that I think it would be good to check out that people are being helpful with. Yeah,
Gail, get uncomfortable. Like, knock. I mean, you can't go knocking on doors, but get uncomfortable, right? Like, there's, and the world is expanding. Even though we're all kind of stuck in our homes, it's like, it's crazy. And I like to just throw myself under the bus. If I wanted to find, under 6 foot tall Italian guys who wanted to start companies together, I could probably spend some time on Google and like find at least a meetup somewhere at some point that might maybe give me one good person, right? Especially networking and mentoring events and like venture meetup events. You might come up with goose eggs, right? And it's possible, but you might just find that one relationship that changes your entire trajectory. So I would challenge you to get uncomfortable a little bit, and that's like
Oh, trust me,
Paul.
this is uncomfortable. I actually, the question was uncomfortable. So
No, it's great.
I'm so
You're
thankful
great.
and grateful for your understanding and to make me feel very comfortable asking. And you guys are awesome. So yeah, this was a stretch. Trust me.
Good job.
It's great. I know we're running out of time, but Alex, you have time for one more?
Yeah, let's do another.
Wayne Sharp had a question about, or a statement about international investment versus the US. Wayne, do you want to ask it yourself?
I don't want to ask him. I was just saying that in my experience, because I'm originally from New Zealand, I've raised money from New Zealand, Australia, Singapore, and here in America. Things take so much longer, and it seems that investors keep here. Institutional investors keep moving the goalposts back and back and back and back and back. It's it's super frustrating for us founders. So what we're doing now, we're actually going into a joint venture raise with one of our new partners, and we're going to, and that for us is like we're now a much better interest. We are much further along. So we'll try and raise money together in the next 2 weeks. But definitely evergreen investment should come back. It is where investors invest in companies as they hit milestones. I think that's the way to help a lot of startups.
I guess and put that in a question phrase. Do you guys think that there are the international investment versus US investments? Is there a better way to go?
The only feedback I have there is I do, and I can only base it off of, for the most part, states that East Coast and West Coast investment conversations are significantly different also. So I can only probably agree with you that some international money is probably a little more aggressive, especially into US based businesses, based off some of the other conversations I've had as well. So for all the founders, especially when you guys are raising money, I would also think about the geography of where you're pitching and who you're talking to, because everyone has a different background that skews their vision on investment.
Mm-hmm.
Yeah.
Well, we don't have time to get to all the questions. So Alex, I'll let you close it up today.
Yeah. Well, this has been great. Thanks again to Kettle Space, and thanks to the panelists. I personally learned a ton of things myself. I'm sure that the crowd did as well. And thank you all for attending. Just very quickly, there will be another event on March 31st at 1 p.m. And that event is all about how to build your team, which is, as an investor, I can say, the most important thing. We're investing in teams. Having the right people on the bus is critical. So I highly recommend everyone join for that. And yeah, thanks again for attending.
Thanks everyone for being here. Alex, thanks for moderating. Panel, thank you all for participating. And everyone else, have a great day. Stay safe. And Mac will definitely be sending a follow-up email with a link to the recording and a link to the next event. Have a great day, everyone.
Thanks, Alex. Thanks, Joseph.
Bye. Thank you, everyone.
Thanks, guys.
Thank you all.
Bye.